Yeah, so chapter 13 is on the exam, so it'll be like everything we talked about up till today. Okay, so we're going to look at chapter 13. And for chapter 13, you can see that we're going to talk about 3 different topics. We're going to talk about auditing. So when you have a not-for-profit entity, you are subject to an audit. Somebody in the other class asked me, what does an audit mean? Basically, it means you have 2 sets of accountants. You have internal accountants that do the accounting and the financial reporting. And then somebody on the outside has to come in and then examine the books and make sure everything looks good. Right? That's called an external auditor. Right? And the only person that legally has the right to audit another person's books and provide an opinion is somebody that has a CPA license. Right, exactly. So as you know from the project that you did, there's an independent auditor's report, and it's really literally 1 page. And the page just says everything, looks good, basically, right? So companies pay millions of dollars just for that 1 piece of paper because they want the audit report. So we'll talk about the standards that apply to auditing, and we'll talk about the fact that there are 3 sets of standards. So if you look a little bit below at number 2, we have GAS, GAGAS, and single audit. Okay, so what's that? GAS? Oh, yeah, generally accepted auditing standards. All right, so GAS, GAGAS is also called Yellow Book, and single audit. So what we're going to learn today is that GAS is the least stringent set of standards. Yellow Book, GAGAS, is more stringent, and single audit is the most stringent set of standards. So those are the 3 different types of standards. In particular, we're going to focus on the Single Audit Act. Did you learn about that in auditing? No?
No.
Okay. Okay. You will learn it in auditing?
We didn't learn it.
Oh, you did not learn it? Okay. Okay. Single Audit Act, basically, if you expend a lot of money, then you have to follow Single Audit Act. We'll talk about how that works. We're also going to talk about taxes, if you move back up to where it says overview. For taxes, not-for-profit organizations file under IRC code section 501c3. That's the most common type of not-for-profit organization. So we'll talk about what that means. And we'll talk about the fact that not-for-profit organizations also have to file a tax return. Even though not-for-profits don't pay tax, you have to file an informational tax return, which is called a Form 990. Okay, so a Form 990 is simply an informational return, providing information on things like how much contribution revenue you received, what were your expenses for the period, also, who are your key officers and how much do they make? How many employees you make as well, right? So if you have a not-for-profit organization that you want to investigate, you can always look at their 990 return, and then they'll give you information on things like how much does the CEO make, right? That's on the 990. We know that not-for-profit organizations generally don't pay tax, right? But in some cases, they could pay tax on something called unrelated business activities. Right? We'll talk about unrelated business activity, or it's also called unrelated business income. Unrelated business income is subject to unrelated business income tax. So UBIT, right? That's simply like saying that you have like a symphony orchestra, and they sell like food at their location, right? If they sell food, that's not part of their mission, and they're going to be subject to unrelated business income tax because they have unrelated business income. So we'll talk about how that works. And then finally, we'll talk about how to evaluate not-for-profits. It's more than just the program expense ratio. We'll talk about other metrics that can be used. Yes, question?
Yeah, I was going to ask, and also like auxiliary expenses?
Yeah, typically auxiliary activities. It's specifically defined as an activity that's not related to your mission or core objective of the organization. So a symphony orchestra, their mission might be to like promote arts to the community. So if they were to like hold like a workshop and charge the public, that would be actually something that's tax exempt because that's part of their mission. right? Like if my mission is to like, give everybody access to the arts, if I hold like an arts workshop or a music workshop and charge people for it, then that's tax exempt, right? If I'm an orchestra and then I sell like cars in a used car lot on the side, that has nothing to do with my mission. That should be subject to tax. And then there's exceptions too. Like if you hold like a bazaar or like a picnic, that's actually considered tax exempt too. So there's two tests, the mission, and then also there's like exceptions to the rule. Okay, any questions on what we're going to talk about? Okay, so when it comes to an audit, there are three sources of auditing standards. If you look at page 1 from the Chapter 13 lecture notes, what are the three sources of auditing standards? We have, everyone was laughing about gas, which is generally accepted auditing standards. Who took auditing in this class so far? Like, okay, so you've heard of GAS? GAGAS is also called Yellow Book, right? Why is it called Yellow Book, you know? Yeah, the rules actually literally are published in a yellow book, right? There's also something called the Beige Book, right? So GAGAS is more stringent standards, and then single audit, it's also called OMB Circular A133. Those are the most stringent standards. Right. Okay, so take a look at page 5. Take a look at page 5, everybody. If you look at page 5, I took this from a different book, illustration 11-10. On page 5. Okay, if you have to comply with gas, okay, so what do you have to do if you comply with GAAS? You have to render an opinion on the financial statements and have a supplementary schedule of expenditures that you incur during the period. What about Yellow Book? What else do you have to include, Jason?
Oh, you have to include the internal control.
Right, you have to also include a report on the adequacy of internal controls. Internal control is simply what you're doing within the organization to prevent misstatements from happening. Right? Misstatements. Misstatement means the numbers are wrong. Right? Misstatements come in two forms, intentional and unintentional. What's an unintentional misstatement? It's an error. How about intentional misstatement? Fraud, exactly. So internal control systems attempt to combat misstatements from both sources, intentional and unintentional. Components of internal control include like separation of duties, establishing responsibility. Those are internal control procedures. What about single audit? If you're going to comply with single audit, you have to comply with 1 and 2, and then also, what else? 3 and 4. Can somebody tell me what 3 and 4 are, Thomas?
Opinion on compliance with laws and regulations, and internal control over compliance appropriately each major program and schedule of findings and question costs.
Okay, so notice that 3 is the auditor's opinion on whether they comply with laws and regulations. So it really goes more than just disclosing the financial statements. It goes into the auditor saying, okay, I've examined the internal control. Here's my opinion on what I think. Right? So it's really like the difference between just providing facts and then providing facts and then like editorial or commentary on top of it. Right? Schedule of findings and questioned costs. Okay, so really that's essentially like a statement of functional expense in the sense that you list out different cost items that you think are material, and then you examine them in greater detail. Okay, so let's go back to page 2, and before we talk about the 3 different standards, let's talk about engagements that auditors can have as part of their work. So on page 2 at the top, you can see we have a financial audit, attestation engagement, or a performance audit. So that's on page 6. These 3 different types of engagements are summarized for you on page 6. So flip back to page 6 and you can see financial audit, attestation, and performance audit. I used to teach for the Princeton Review. When I was younger, I used to like taking standardized tests for fun. That sounds really bad. And then I taught for the Princeton Review, and then they would teach us to say, like, turn to page 800, now turn to page 741, and then turn to page 802. And then you can tell if people are following you because literally they should be on the same page as you. So that kind of reminds me of that. Okay, so on page 2, let's summarize these in simple terms. Financial audit. Attestation engagement. Okay, so people who took auditing, you can help me out here. Performance audit. Okay, if you take auditing is really about a financial audit, right? A financial audit is where the auditor is going to render an opinion on the adequacy of the financial statements. So, an opinion on financial statements. In particular, are they fairly presented? In all material respects. So a financial audit is simply just looking at the statements overall and then making a determination as to whether you think the financial statements are properly stated or not properly stated. Okay. If you have a financial audit performed, what kind of audit opinion can you expect? Look at number 4. What are the 4 different types of audit opinion statements? Safiatu, what are they? Unqualified. Anybody know what else it's called?
Unmodified.
Unmodified, right. Qualified. Is that called something else?
These.
It's also called modified. Also, you have disclaimer and adverse. Okay, so I'm going to pretend I'm a not-for-profit entity and I have to pay an auditor to come and then examine my books, right? So the auditor is going to come, examine my books, and then they're going to give me one of these 4 opinions. Unqualified means everything is okay. This is not an auditing class, so in auditing you have to learn like the exact language, right? So this is not auditing, so basically everything is okay. I use the word okay on purpose because does okay mean perfect? No, it just means it's fine the way it is, right? Not perfect because how can it be perfect? It would be prohibitively expensive for an auditor to make sure everything was perfect because they would have to like look at every single thing, which they can't do, right? Qualified means but for, except, right? So but for. So when somebody says but, usually they're going to change directions, right? I don't know, like if you've been in a relationship, I like you, you're a nice person, but, and then it's going to head in a different direction. So qualified or modified opinion would be saying something to the effect of the financial statements are properly stated except for your inventory recognition principle that you're using, right? Or your financial statements look good except for your methodology that you're using for recognizing contribution revenue. We think it's overstated. Okay, that's going to be qualified or modified. Right? What does a disclaimer opinion mean? Right, it means I don't know. Right? Now that's kind of silly. Like, why would you pay an auditor millions of dollars for them to write a 1-page piece of paper that says I don't know, right? But this could happen legitimately if, for example, there is some kind of scope limitation with the work that's being performed. That means, for example, I'm a not-for-profit organization, and I have an audit performed on my books, and all of my accounting records get burned in a fire, plus all the data backup on the cloud, right? So there's nothing for them to look at. So then they don't know if the financial statements look legit or not because there's nothing to look at. That's going to be a disclaimer of opinion. What does an adverse opinion mean? It means it's bad. Right. So adverse opinion would be, for example, if there's some kind of significant material misstatement. Right? Like, for example, there is such a deficiency in the accounting that I can't trust any of the numbers on the financial statements. Like Enron would be an adverse opinion. Right? WorldCom would be an adverse opinion because the numbers, you don't know if any of the numbers are legit or not. Right? Okay, good. So this is a financial audit. By law, not-for-profit entities have to have a financial audit done in general. And also, for-profit entities that are publicly traded, all of them have to have a financial audit done. Right? I remember when I worked at PwC, the partner that I worked for, he would always try to underbid the audit engagement to get the client in the door. And so he had these investment clients, and he was hoping that the client would become the next Google or Facebook, because when they did become that successful, he would jack up the rates and then make the money that way. So that was the business side of public accounting. No, it didn't really work that well. Okay, what is an attestation engagement? Anybody know? Afra, do you know what attestation engagement is?
Would you request?
Okay, yes.
Providing reasonable assurance.
Right, okay, you provide reasonable assurance. Typically, it's on a component or compartmentalized basis. Right? So reasonable assurance on a specific matter. So, for example, you could say, it's like a la carte at a restaurant, right? Instead of buying the whole meal package, you can say, I want you to just only look at my internal control and provide some kind of opinion. Or only look at accounts receivable and provide some kind of opinion. That's an attestation engagement. Now, performance audit is a third type of engagement that not-for-profit entities can engage in. And a performance audit can fall under one of two types. We have a program audit and economy and efficiency-driven engagement. So a program audit is simply an audit where somebody looks to see, did you achieve your mission or your objective? Right? That's a program audit. So performance audit can be program audit. Did you achieve your objective or mission? Right? If I am a not-for-profit organization that is charged with helping people in the community, did I do a good job helping people in the community? How many people did I help? How many people were impacted by the services that I provided? Right? So that would be under a program audit. You can also have a performance audit that is economy and efficiency based. What does economy and efficiency mean? Anybody know what economy, efficiency, what does that deal with? Yes. Right, so really simply stated, economy and efficiency, essentially the same thing. It's generating a given output by minimizing your input. So given output by minimizing input. Like if you want to get an A in auditing and you study 80 hours a week, yeah, you got an A, but are you really efficient? Maybe not, right? So that's economy and efficiency. All right, I have a question. What is the difference? What differentiates financial audits from performance audits? What do you think? How would you differentiate financial versus performance? Jason.
Well, financial just deals with just your your books versus the
It's holistic. It's general, right? Generally are the books properly stated. So it's more of a general construct, right? How about performance?
more specific.
There, it's more specific in nature, exactly. So it's more specific. Good.
You could say the same thing about the attestation.
Sure. Attestation is certainly specific as well. So we could apply that over here as well. Exactly. Okay, good. Have you ever seen an entity that has a qualified opinion? Very rarely. It doesn't happen very often. How about disclaimer? I've personally never seen that happen. Adverse? You seen it, David?
Oh, no.
No? I've never seen this either, actually. So most of the time, opinions are unqualified, unmodified, or sometimes you'll see qualified. Right?
It's just like, I don't think it would be in the CPA like firms like business, like
Interest?
interest to ever issue anything like adverse.
Mm-hmm.
Like,
Oh, I agree with that.
Or they'd be like a qualified or a modified and then say what it was instead of doing that.
Yeah, when I was a manager in public accounting, we would sometimes feel like we had to issue a qualified opinion, but then we would give the client a chance to like make adjustments to their books. We would say like, we're not comfortable with your inventory valuation. We think it's overstated, so we're going to have to do a qualified opinion unless you make a journal entry to write down your inventory value by $200,000. And if they did that, then we would issue an unqualified opinion. Jason, do you have something? All right, so then if you're going to issue an opinion, do you issue an opinion just for the entire organization? Maybe, right? Because you saw that for the project that you did, right? So when you did like AU or Baylor or GW, there was an audit opinion rendered for the entire organization. Yes, sir.
Why did you pick Baylor?
Yeah, I really wanted to know that when I was doing it.
It just came to mind. I mean, AU obviously because it's AU here. GW because I went there. And then Baylor, I was just like, oh, I just pick something. So that's why. And then I looked at their financial statements, and it looked like really like clean, and like I thought I could ask good questions on them. That's why. By the way, if you did Baylor, number 6 and 9, a lot of people ask me about those two questions. Isn't it the same answer? It is.
That was tricky.
It was it was the same answer. But if you did another school, it might have been a different answer. That's why. But a lot of people ask me, why is 6 and 9 the same thing? Okay, but if you issue an opinion, it doesn't have to be on the entire organization. What else can you issue an opinion on? Number 5, on page 2. You can render an opinion on an entity's governmental activities. What else? There are business type activities, or you can also render opinions on funds, right? So if they have different funds that are being organized and that are running, you can issue an opinion on the major fund. You can also issue opinions on component units. Remember we said component units are like a separate column, right? So a lot of this is actually tying back to governmental, state and local accounting as well. Or you can issue an opinion on the aggregate of remaining fund information. For example, you know how they have like a miscellaneous or other category? You ever see that? So you can issue an opinion even on the other category. Good. All right, any questions on that? Okay, let me talk about a few more things and we'll take a break. Okay, so on the exam next week, I'm going to put a big problem on the Single Audit Act. Okay, so we'll talk about what that is now. Number 1, the Single Audit Act is the most stringent form of auditing standards that you could comply with. And when do you have to follow the Single Audit Act? Exactly. If you make and expend a lot of money, in particular, federal money, right? So look at page 2, number 6. If you receive and expend more than $750,000 in federal funds, then you must use the Single Audit Act. What if I have less than that? Can I still use the Single Audit Act? If you want to, you can. But if it's more than $750,000, you have to. Yes.
So if you receive like $250,000 federal funds a year, like you don't spend any of it till like the 3rd year, so then just that year you have to file it.
Yes, exactly. So then you'd have to comply with the Single Audit Act. So the question was, if you like receive $250 and then you just like keep the money and then all of a sudden you spend the whole thing in the 4th year, yes, you would have to comply with the Single Audit Act. Now, I want you to know that the important part of the rule is that you have to expend more than $750 in federal funds. Okay, so it's not receiving, it's expending. But how can you expend if you didn't receive it? That's why it says receiving and expending. So the rule is, if you spend more than $750 in government money, you must follow the Single Audit Act. Right? What if I just receive $1 million and then I just put it in the bank and didn't do anything? Single Audit Act this year? No. You have to spend the money, right? Okay, so under the Single Audit Act, they name different types of organizations based on how much they expend. So if you expend less than $50 million, then you're considered what? You're considered an oversight agency, right? If you expend more than $50 million or equal to $50 million, so $50 million or more, then you are a cognizant agency, right? It's kind of like saying, are you a small fish or big fish? Right? Less than $50 million, small fish, oversight agency. $50 million or more, cognizant agency, big fish. I have a question. What if I spend $750,000 in federal money? Single Audit Act, yes or no? No, it says more than, right? So I have to spend $750,000 and 1 cent or more. That's going to be Single Audit Act. Good. Okay, so what's the purpose of a Single Audit Act? What do you think? Well, I understand that if you're spending government money, and you're spending a lot of government money, you should be held to a higher standard. But look at the objectives at the bottom of page 2. The objective of the Single Audit Act is to ensure that financial statements of the entire entity can be relied upon. Okay, that's really nothing new because that's true with every entity. Right? And then Single Audit Act ensures global entity compliance with federal laws and regulations. Right? So there's another layer of laws and regulations you have to comply with in order to have to meet the requirements for the Single Audit Act. Okay, let me mention this last thing, and then we'll take a break. Any questions first? Do I keep saying last thing, last thing, last thing? I do? Okay.
You said a few more things.
A few more things. Okay, oh, then I don't feel bad. All right, look at page 3, and then we'll take a break. I like auditing because when I worked in public accounting, I started as an auditor. And then I worked in tax, and then I moved into governmental and not-for-profit. That's like what my specialty is. So I have a special place in my heart for auditing. Anybody doing auditing after they graduate? How about other people? What are you going to do?
I'm doing
Tax?
internal accounting.
Tax. So auditing is like more travel because you have to go to the client site. And then tax is more stay in the office and then do the work. And then consulting is typically more like travel and like interacting with clients. I'm just generalizing. When I worked in public accounting, like it was a little bit cliquey because like audit people thought they were like really cool, but then tax people thought they were really cool, consulting people thought they were really cool. But the truth is everybody like relies on each other. Everybody's cool. Everybody is cool in accounting. That's exactly right. All right, so this is the idea behind the Single Audit Act. And then if you took auditing, I'm sure you've seen this before, right? Okay, so the purpose of any audit is to reduce what we call audit risk. Okay, so I'm going to tell you what these terms mean. AR means audit risk. IR means inherent risk. Inherent risk. CR means control risk, and DR is detection risk. Okay, so as an auditor, your job is to go in and examine the books, right? There are 2 things that you can do to examine books. You can do substantive testing and analytical review. You don't need to know that. But substantive testing means like you actually like look at the number carefully, like you verify that it's correct, you trace and vouch source documents. Analytical review is like looking at trends to see if the number is bigger than last year. There's a lot of tools you can use to examine numbers to make sure that they're properly stated. But your goal as an auditor is to make audit risk lower, right? You're not trying to make the risk 0 because there's always going to be some risk, right? You want to reduce the risk to an acceptable level. So to reduce audit risk, there are three components that tie into audit risk, and you can only control two of them. Inherent risk you cannot control. Inherent risk is like non-diversifiable systemic risk. Like, for example, if you were going to audit a casino handles a lot of cash, right? That's an inherent risk. But you can't tell casinos you can no longer handle cash because that's their business model, right? So you just accept the inherent risk, right? When I volunteered for the lymphoma leukemia walkathon that I told you about before, they handled a lot of cash too. I mean, what if they told people we don't accept any more cash? Probably their donations would go down because some people just want to give cash, right? So inherent risk is going to be there no matter what. You just accept it. And every company has some inherent risk. Right? Control risk is the risk that the system doesn't work. That's what control risk means. So if I have a not-for-profit organization, I should have some kind of control system in place. Like, for example, I have a safe, right? Or you have to use a password to log into the system, right? Or I don't have two people, the same person doing like everything. Like I spread it out. Like, you know, Thomas is going to do the accounting. I'm going to handle the cash, right? That's how you reduce your control risk. Right? You want control risk to be low, right? Casinos, what they do is they have like dealers and security people like use different entrances and exits, so they never like run into each other, so they don't like become friends. Right? Because if they become friends, what happens? They're collude, and control risk may be higher, right? Detection risk is a function of the work that the auditor does. If I like examine the books more, then the detection risk is going to go down. If I don't bother to look at the books at all, detection risk is going to go up, right? Okay, so does it make sense what these different components mean? Control risk is how effective the system is. If the system is very effective, I bet you control risk will be low. The risk is low. It's not risky. If the system within a company or entity is bad and people can steal money whenever they want, there's money lying around and the accounting records are like really poor, then the risk, the control risk is going to be very high. Right? As an auditor, if I don't do any work, then the detection risk is going to be high. If I look at the numbers in more detail and do more substantive testing or analytical review, detection risk is going to tend to go down. Right, exactly. So the point here is that if this is high, like if the system is really messed up, then you better do more work, right? And make this low so that it will balance out, right? If the system in place at the organization is awesome, then the risk that you have from the controls are going to be low, and then you don't have to do as much work, and then you can allow detection risk to be higher, right? Yes?
You said that auditors can only change two of them, but can't they only change detection risk?
Yeah, that's right.
Well, they can influence control risk to the extent that you can like try to talk to management and then like counsel them into like beefing up their control systems. And then with Sarbanes-Oxley, you've heard of Section 404, you have to render an opinion on the control system, which is kind of like an indirect way of pressuring management to like improve this part. Right?
But that's only public, right?
It's for public, yeah, exactly. You can provide advice to your not-for-profit entity and then give them suggestions on how they can be more effective in handling their assets. And that would tend to influence the control risk to some extent too. But I would agree that the factor that auditors control the most is this, number one. And then to some extent, number two, inherent, not at all. Okay, so as we take our break, what I want you to know is that this is not a perfect thing, right? In a perfect world, wouldn't you want to make everything low, right? But you can't. So what is your approach to auditing? If you can't have everything be perfect, you can control detection risk, you have to strategize, and you have to use what's called a risk assessment model, right? Risk assessment. Or risk-based model. That means you can't do everything, so you have to pick and choose what you are going to do. Right? That's a risk-based model. That's important when we come back from the break because we'll talk about how that ties into the Single Audit Act. Okay, folks, we're going to get started again. So let's take a look at the Chapter 13 packet. Before the break, we talked about the Single Audit Act and how the Single Audit Act is based on a risk-based approach. Risk-based approach means you can't do everything, so you have to do the riskiest things first, prioritize them, and if you have like 10 different programs, you're not going to be able to look at all 10 programs because it's just not physically possible. So you have to figure out which are the most risky programs, and once you identify the most risky programs, audit those programs for sure, but you want to make your audit procedures have some degree of randomness to them, right? So like if you have to comply with Single Audit Act and you have 100 programs, there's no way I'm going to be able to audit all 100 programs that you have. So maybe I can only audit the most risky programs, like the top 10 most risky, right? But if I just do that, then people can game the system, right? Because you can figure out yourself which are the 10 most risky programs, make sure those look fine, and then the other 90 are not properly stated, right? So what the Single Audit Act is doing is it's saying I'm going to look at the most risky programs, I'm going to prioritize my work, but then I'm going to introduce some form of randomness so that you can't tell exactly which programs I'm going to look at, right? That way it keeps everybody on their toes. Okay, so before we talk about the Single Audit Act, let's do a couple of multiple choice questions to recap what we discussed before the break. On page 12, let's look at the multiple choice questions, numbers 1, 2, and 3. Okay, so I'll read these. It says, number 1, an audit of a government conducted in accordance with generally accepted auditing standards would include what? When they say audit, what's the default? When somebody says audit, they're talking about a financial audit, right? Program audit, or performance audit, or some other type of audit has to be like specifically stated because the default when somebody says audit is they're talking about a financial audit. Okay, so if you do a financial audit, is it A, you have to determine efficiency and effectiveness. Is that true for a financial audit? No, I don't think so. Where does that come into play? Efficiency and effectiveness, maybe more of a performance audit, right? How about B says you have to examine the financial statements and underlying records to make sure they're conforming to generally accepted accounting principles? Yes. That sounds kind of good, right? So maybe that sounds good. C says you have to test for compliance with laws and regulations. To some extent, you would test for compliance. What do you think?
Yes.
Yeah. So, what do you think? D? Both B and C? Yeah. What about number 2, Single Audit Act? What's the rule again? Single Audit Act, most stringent set of standards. You have to use it if you spend more than $750 in federal government money, right? So number 2 says, one of the primary purposes of the Single Audit Act is to, A, detect fraud, waste, and abuse. What do you think? I mean, that sounds good, but is that really what it's designed for? To detect fraud? You know, not really, because if you're trying to detect fraud, that's kind of like saying, you did something wrong, I'm going to find out what it is, right? That's not really the presumption that you make, right? When you're doing a general audit or performance or financial audit, you're not operating under the presumption that they're doing something wrong. You're just trying to follow your procedures and make sure everything looks the way that they're supposed to look. So it's not A. How about B says, to promote the efficient and effective use of audit resources by consolidating audit activity into one organization-wide audit. I don't know. Keep reading. C says, make audit activity legal at the federal level. Sounds kind of silly, right? You don't need the Single Audit Act to make audit activity legal. Allow federal auditors greater access to government entities receiving federal funds. Nobody ever said that. Right? The answer is B. To promote efficient and effective use of audit resources. Okay, so that really ties back to this risk-based assessment approach. Effective use of resources. If I'm going to do a most stringent set of audit procedures for your entity, and you have 1,000 programs, I'm not going to be able to look at all 1,000 of them. I'm going to have to pick and choose based on what are the most risky programs, and then have a set of procedures that introduces some element of randomness, so you can't predict what I'm going to look at. So number 2 is B. What about 3? Which of the following statements concerning the Single Audit Act is correct? Okay, we know Single Audit Act means you are spending more than $750 in federal funds. Keep saying that, but you'll know it for the exam next week. A says only requires entities receiving over $750 a year. I mean, it's not about receiving the money, it's about spending it. B says Single Audit Act only applies if an entity has high risk programs. That's not even like when it applies. It applies if you spend more than a certain amount of federal money. C says the Single Audit Act is optional for all entities. No, it's not. D. Those entities expending under $750 a year in federal awards are exempt from the single audit requirements. That's true. Doesn't mean you can't follow the Single Audit Act. It just means you don't have to. All right, any questions? All right, let's actually apply the Single Audit Act. Anybody ever learn about this in another class? No? Okay. All right. Look at page 3 again. Page 3, look at the second bullet point on page 3. It says risk-based approach to audit target selection. Okay, so we know that if we're using the Single Audit Act, the goal is to reduce our audit risk. And what we do is we're going to classify programs into one of 4 types. So you can see on page 3, you can have a type A program or a type B program, or you can have a high-risk program and a low-risk program. That means that when you apply the Single Audit Act and an entity has 12,000 programs or 12,000 initiatives, you're going to classify each initiative, each program, each line of activity into one of 4 types. Type A, high risk, A, low risk, B, high risk, B, low risk. So I'm going to perform a Single Audit Act guided engagement for your entity. You told me you have 600 programs. I'm going to classify them as either A high, A low, B high, B low. Okay, so in short, A just means large dollar value. Okay, so type A means large dollar value. Means a lot of money. Type B means low dollar value. And then you can have high risk and low risk. So this is important when you're doing the Single Audit Act because look at page 8. Look at page 8. You see we have a set of standard operating procedures for Single Audit Act. You're going to identify type A, high risk, type B, low risk, that's step 2. Step 3 is type B, high risk. Step 4 is type B, low risk. Right? Okay, what does that mean? High risk, low risk, type A, type B. I have on page 9, Exhibit 5 for the Single Audit Act. Look at page 9, everybody. Page 9. Okay, I'm going to put the, you see where it says total federal awards expended? I'm going to put that part of page 9 on the exam next week. Okay, so page 9, you see like there's like the chart at the top and at the bottom? You see, like with all the numbers, like 300,000 to 100. I'll give you that next week. Okay, so how do you know if something is type A? Well, it depends on how much money you spend, right? If I spend $10 million, what does type A mean? Type A means it's the larger of, you just read what it says. It says larger of 300,000 or 3% of federal awards expended. Okay, we're going to do some problems together, so I mean, I can tell you what it means, but it kind of doesn't make any sense until you do it. What does high risk mean? High risk means that you meet one of these 6 different characteristics for a high risk program. What are some indications of high risk? What does it say in the?
Weakness and internal control.
Okay, so internal control weakness indicates a high risk program. What else?
Significant flow through of funds.
Right, a lot of money coming in and out.
So would that be like activity?
A lot of activity, yes, exactly. So if you have a fund that just has money coming in and either nothing going out or only a little bit going out, that's not a significant flow of funds. Third, Morgan?
Newly installed computer systems which are not adequate.
Right, so a new computer system or new AIS system is an indication of high risk. What else?
Absence of recent audit.
Right. A program that's never been audited or hasn't been audited for a significant period of time is considered to be high risk.
Complex compliance required.
Sure. So if you have, for example, a not-for-profit that engages in something that is like highly regulated, like nuclear energy or something, that would be considered a high-risk activity, high-risk program. And
Relatively new program.
a new program is also considered high-risk. Okay, so let's see about how the Single Audit Act works on page 13. I'm going to put a problem on the next exam next week. Something like 13. Okay? Page 13. By the way, I made a special handout for you. I don't know if you saw it, but it was on the Single Audit Act. Did you see that?
Yes.
So I did that.
So are you doing this everything on page 9?
I'm sorry, page 9?
For the exam? What parts?
Oh, I'm just going to give you like the numbers.
The threshold?
Yeah, the thresholds. So you don't have to memorize them. But you have to, like, I'm not going to tell you, these are the indications of a high-risk program. Like, I'm not going to do that. All right, so let's use the Single Audit Act. Let's see how this works. Look at page 13. So page 13, chapter 13. All right, so we have ABC agency. They expended federal awards during the most recent fiscal year in the amounts listed below. Okay, how much money did they spend? $13,503,000. So they definitely spend a lot of money. So they have to follow the Single Audit Act. Remember, if you spend more than $750 in federal money, Single Audit Act. It says programs A and E were audited as major programs in each of the last 2 preceding fiscal periods. Okay, that's fine. And then you see the threshold there? I'll give you that on the test. Okay, let's answer these questions. Does ABC need to comply with the Single Audit Act?
Yes.
Yes. So I'm just going to number this number 1 just for our purposes. Yes, because expended more than $750 in federal money. All right. Okay, now it says in the second part, define type A and type B. Remember, A means high dollar value, B means low dollar value. Okay? So what we do is look at the threshold. What is the threshold rule? What does it say? Thresholds for type A program. Take the larger of 300,000 or 3%, and that's a type A program. Anything that's that number or more is type A. Okay, so let's see. 300,000, or we're going to take 3%, the 0.03, times the total. The total is 13,503,000. 503,000. Yeah, so we use this number. Okay, so it's 405. You did it in your head?
No.
Oh. No, that's impressive. You did. Okay, is that right? I don't know. I didn't.
Yeah, that's right.
Okay, all right. So take the bigger. This is bigger, so we're not going to use this number. Okay, so that means type A is anything that is greater than or equal to 405,090. Okay, that's type A, right? If it's less than 405,090, it's considered to be type B. Right? Does that make sense, everybody? Okay, so that means type A means high dollar value. In particular, if it's 405,090 or bigger, then it's type A as a program. If it's less than 405,090, it's type B. Okay, let's look at the top part now. So let's just rank each part. We've got program A, B, C, D, E. Okay, so the point is, we don't have enough resources and time to examine every single one, right? Like, what if they had 3,522 programs? You can't look at every single one. It's impossible, right? So, is A type A or B? I'm sorry, is program A type A or B? A. It's type A. How about program B? What type is that? B. How about program C? A. How about program D? A. And program E is B. See? Okay, next, we want to figure out, is it high or low? Okay, so the default is high. Because you're an auditor, you're supposed to be skeptical. So if you don't give me any information on what's happening, I'm going to assume it's high risk. Unless you can prove to me it's low risk, I'm going to assume it's high risk. Look what it says in the problem. It says programs A and E were audited every year for the last 2 years. And I should probably add, and the audit opinion was unqualified. Everything looked good. So isn't that trying to give me some evidence to suggest that A and E are low risk, right? So A is low and E is low risk. Does that make sense? So then everything else has to be high risk. Everything else has to be high risk. Okay, so going back to this problem, page 13, identify all the type A high-risk programs. A high is program C and D, right? So on page 13 at the bottom, it says identify the type A high-risk programs. It's program C and D. That's the answer, C and D. Look at page 14. It says identify the type A low-risk programs. So it's just A, right? Program A. So write that down. Program A. What's the B high programs? Identify the type B high-risk programs. That's program B. Program B is type B high-risk. Right? Finally, it says identify the type B low risk. That's program E. Right. Program E. Yes, sir. Yeah. So high risk, if they don't say anything, it's high risk. If they give me evidence that it's low risk, then I can assume it's low risk. Or what if I say, for example, program X has a newly installed computer system? Then it's high risk, right? How about if I say program Z has a significant flow of funds? It's high risk. What if I say program letter L was examined in each of the last 2 years and nothing was found? We deem this to be a very compliant program, okay, they're trying to tell you it's low risk. On the test, if you have questions like that, you can ask me. Not for the answer, but I can tell you, like I can kind of guide you a little bit. All right, any questions on that? Okay, the reason why we did all this is because we want to figure out which programs to target for audit, right? That's on page 14, the last question. It says, which programs should be selected for audit and why? Well, in a perfect world, I would just do everything, right? I mean, why not? But, well, why not is because I don't have the time to do that, and it's prohibitively expensive. I can only do certain programs. I'm using a risk-based approach. So this is where there's a lot of different variations of the rule. Okay, so the rule that I want you to know is audit all A high, ensure at least 50% coverage. This is the general rule. If not 50%, go to B high, and then A low, B low. Okay, again, this rule can vary, but what they all have in common is that everybody agrees that you should audit all of the A high, because that's the most risky programs that are out there. Not only are they large dollar value, but they have a lot of risk associated with them. So every A high you should audit. And then C, are you doing at least 50% of everything? If not, you have to do more. Yes?
50% of the dollar.
Dollar value. Not 50% of the number, but the dollar value. Dollar value coverage. Okay, so dollar value. 50% of the dollar value. So let's see. What I'm going to do is I'm going to type these answers out for you because I think that. Okay. All right. So what do I have to look at? Program. Well, obviously C and D, isn't it? C and D. How much coverage is that going to give me? I don't know. C is 1.1 mil, right? How much money does D spend? 5.6 mil, right? Okay. So if I add that up, that's 6,700,000. Is that enough?
No.
No, it's not enough. Because I need, if everything is 13,503,000, I need 50% coverage, right? So that means I need to do at least how much in dollar terms?
6,751,500.
This is not enough. I need a little bit more, right? So then you're going to go to B high, right? I have a question. What if you have 3 B high? Which one? No, you just pick whichever one you want. Because if you always do the highest one, what does that mean? Then there's a pattern somebody can catch on to, and then your audit is not very effective, right? So if you have 10 B high, you have to get the 50%, but you pick which ones and you can mix it up, right? Maybe I'll do a couple of little ones to throw people off, and then I'll do a different one, right? That's where the randomness comes in. This is procedural. There's steps that you take, and then it's also some element of randomness. You don't need to know this for the test, but actually, for every B high, you should do 1 B low. Because then that adds more randomness in there, right? But just know this rule. This is what I'm going to ask you on the test. Anyway, so there's only 1 B high, so we have to also look at B, right? And then does that put me over 50%? Yes. So that's it. That is it. All right. Any questions on how that works? All right. We're going to come back to that a little bit later because we're going to take our group quiz. But when you see something like this on the test next week, I'll ask you, How do you know if it's single audit? I'll ask you, what does type A and type B mean? What are the programs going to be classified as? Are they A, B, are they high or low? And then which programs you would look at. Again, you look at all the A high, and you need at least 50% coverage. All right, any questions on that? All right. Okay, let's take a look at page 3 again. Do not-for-profit entities pay taxes generally? No. If you look at page 3 under taxes, not-for-profit entities have tax-exempt status, right? So what's a 501c3? It includes religious, charitable, scientific, literary, educational, amateur sports organizations, organizations to prevent cruelty of children or animals, I'll have to change that, and substantial political activities prohibited. Right? So what you should know is that if you're a not-for-profit entity, you can be a 501c3. Look at page 10. Take a look at page 10. Everybody's heard of a 501c3 probably, right? You can be a 501c1, C2, C3, C4. What if you were like Pleasant Slumbers Cemetery? What kind of not-for-profit is that? C13, right. How about the American Association of University Professors, which I'm a member of, AAUP, what's that? Okay. Voluntary Employee Beneficiary Organization, 501c9.
Are we gonna have to know?
No. I'm just telling you that there's more than one. Okay, one more. How about the Greater Washington Tree Climbing Club? 501c7. You don't need to memorize these. I'm just telling you there's more than one. Okay, on page 3, going back there, not-for-profit organizations have to file a informational tax return, right? It's called what? A Form 990. If you go to guidestar.org, not-for-profit entities are required to file their tax return there, so you can actually look at them, right? So guidestar.org, that's not on the test, but just for your own information. All right. So I have a question. If you are a not-for-profit, you generally don't pay taxes, right? Unless you engage in something that's not part of your mission, right? So look at this. On page 3, you see tax-exempt, unrelated business income, UBI. What's considered tax-exempt? Like, let's say I'm like, St. Mary's Catholic Church. What would be some things that I could do where I don't have to worry about paying tax? It has to be not carried on regularly, so I could have like a church picnic once a year. It's not regularly, so I wouldn't have to pay tax for an event like that. Also, something that is run by volunteers, and if you have something that involves sales of donated items, like a church bazaar, you wouldn't have to pay tax on the proceeds from that.
Does it have to meet the criteria of each one of these, or just a couple of them?
What it is actually you would have to test all 3 things. So it's really like a judgment call, because the truth is, if you have like a church bazaar, do you have like all volunteers, or don't you have like some like people who work full-time for the church also doing it? So it's really like a judgment call. What are some examples of other things where I don't have to pay tax? Operated for convenience of employees and patrons. Like I went to Marriott headquarters in Bethesda, and they have a cafe in the basement for employees, and I ate there. So, I had to pay to eat there, but they don't have to pay tax on that money. If you have like a church that has a cafe or coffee shop, and you're doing it just for the convenience of people who work there, you don't have to pay taxes on that. What if you have like a vending machine at a church? You have that there because it's for the convenience of employees and people who go to the church, so you don't have to pay tax on the money that you generate from that. What else is considered not subject to tax? Okay, what's the next thing say? Royalties, dividends, interest, and annuities. Yeah, if I have a bank account and I earn interest, I don't have to pay tax on that. What else? Research revenues. So this applies more for scientific organizations, organizations that are not for profit that engage in research activities. Research revenues are not subject to tax. Typically, like grants, for example, are not going to be taxable. What else?
Income from public entertainment at a fair.
Right, so if you have a fair and you generate money from that, you don't have to pay tax. What else? Revenue from labor, agriculture, or business trade shows. So if you have a trade show, no tax. And this one kind of really bothers me, but it's true. If you have income from rental or exchange of membership lists, then you don't have to pay tax on that either, which I think happens a lot. You get a lot of phone calls on your cell phone because, like, you give somebody your number and then they sell your information to somebody else. If a not-for-profit does that, they don't have to pay tax. So it's almost like an incentive to do it, right? All right, I have some questions for you. Let's look at page 16. Page 16, we have the Silverton Symphony Orchestra. Let's figure out on page 16, are they subject to UBIT or not subject to UBIT? What is UBIT? Unrelated business income tax. In other words, do they pay tax or not subject to tax? So we're going to use the criteria that we just mentioned. And also, another thing you can do is think about what the mission of the organization is. If you're generating money by doing something that's part of your mission, no tax. If you're doing something that's not part of your mission, pay tax. Right? Like if Silverton Symphony Orchestra got into the home flipping business, that would be subject to tax. Right? Let's go around the room and start with Jason. Number 1, what does it say?
Sale of Silverton Symphony Orchestra concert CDs in the facilities gift shop.
Okay, well, first of all, what's their mission? We better read that.
Yes, the mission would be to.
It says its mission is to.
Its mission is to increase access to the arts for the community of Silverton.
So make the arts available to everybody. Okay, so if they sell CDs, who buys a CD? But anyways, do they have to pay tax on that or no? Isn't that supporting their mission? Like, I want people to listen to music, so I'm going to sell you a CD and listen at home, right? So not subject to UBIT, right? How about the next one? What do you think? Miller, you can read that one.
Rental of the facility to the high school drama club.
Do you think that promotes access to the arts? I think so. So not subject to tax, right? Who wants to read the next one, number 3? To the symphony. I don't know. What do you think about that one? Maybe we should go back to the notes. Does that fall under anything that in the notes? Operated for the convenience of employees and patrons. So if you rent 2 apartments to the symphony, you have a guest performer showing up, you let them stay in an apartment so that they don't have to commute too far. That's going to be not subject to tax. Not subject to tax. What about number 4, Grace? What do you think? Can you read that?
Sale of the season ticket membership list to a local music store.
Oh my gosh, they sell the membership list? That's, I have a problem with that, but pay tax or no? No, that's one of the things that specifically you don't have to pay tax on. So the first 4 are not subject to UBIT. 5, it says rental of the facility to the State CPA Association for continuing professional education events. What does that have to do with increasing access to the arts? It doesn't. That's just like a side hustle, right? So you have to pay tax on that money, right? So pay tax, subject to UBIT. What about internet sales of gift shop items with the Silverton Symphony Orchestra logo, like a tote bag with the logo on it? What do you think about that? Or like I don't know, like a fidget spinner with the logo on it. What do you make of that? Pay tax or not? Does that increase access to the arts if I sell you a tote bag? Okay, that one I think you could argue because like if it says, oh, listen to music, visit us at www, whatever, you could make an argument. But if it just has the logo, what's that?
Isn't it for the community? So what if nobody from the community is buying?
Oh, so you're making an argument for pay tax?
Yeah.
Yeah, I would say pay tax. Because what if you sell what is something like, what do they sell at a gift shop that's usually kind of corny? That keychains with the logo on it. How does that increase access to the arts? I don't think it does. That's not part of their mission. You should pay tax. 7, it says lease the facility's parking lot to the local university on football game days. You should pay tax, right?
What if it's the orchestra, or the band people who stay there?
Oh, in that case, you're doing that for the convenience of people that are part of the symphony, and also that you can argue promotes the mission of your organization. Then you wouldn't pay tax. Any questions on that? Okay, we only have 2 more things. On page 4, I have a question. What would happen if I have a not-for-profit and I pay myself like $2 million? That's called an intermediate sanction on page 4, right? Intermediate sanction means you give an excess benefit to a disqualified person. Right? Like what if you start a church and then I'm going to just pay my friends like huge salaries, and we don't have to pay any tax, ha ha ha. Right? That's called an intermediate sanction. Right? So it's defined as paying an excess benefit to a disqualified person. What's an excess benefit? Unreasonable compensation, selling something at a bargain price. Like I'm going to sell you a $50,000 Mercedes for $2,000. That's an excess benefit that you're getting. You're getting something for cheaper than you should. And something that's not arm's length, right? Who's a disqualified person? Somebody that has substantial influence over the organization's affairs. If you engage in an intermediate sanction, you can lose your tax-exempt status and be subject to other penalties and fines. Can you give me an example of an excess benefit to an disqualified person? Think of an example. Yes.
So in the news, you talk about like this woman who got a Ferrari for her husband, or like a Lambo, or like that, like in the church.
From the church?
Yeah.
Yeah, that would certainly be an excess benefit to a disqualified person, right? What if like the priest said, "Oh, but I need to look good because I represent God," and what do you think? That's still an excess benefit to a disqualified person, right? How about page 16? I'm sorry, leave it 16. 17. Let's look at 17. And you tell me, is this an excess benefit to a disqualified person? Tell me yes or no. Yes?
I'm sorry, what did you say disqualified?
Disqualified person is somebody who has a lot of influence. Yeah, like for example, like in a church, maybe like the priest, the people who serve on the board of directors, like a high-ranking employee, right? How about an AU? AU is a not-for-profit. Who would be a disqualified person? Board of directors, board of trustees, the president, anybody like at the provost level, probably. Somebody who has a lot of power, right? Me, not so much, right? Okay. Can somebody read number 1? Thomas. Jane?
Jane is president of IRC Section 501c3 public charity and personally owns a building that she has decided to sell to the non-for-profit organization. The appraisal value is $200,000 and the agreed upon selling price is $250,000.
Okay. Is Jane a disqualified person? Does she have like a lot of power? I think so if she's the president, right? Is she getting an excess benefit? I mean, it is actually an excess benefit because if you have something worth $200,000 and you sell it to the not-for-profit for $250,000, you're getting extra money, right? So, intermediate sanction? Yes. Yes. Okay, I'll read number 2. You tell me what you think. A large public charity is very happy with its president's performance and offers him a new compensation agreement for the coming year. He will receive a base salary plus a percentage of the increase in gross revenues of the organization with no limit as to the maximum amount. Wow, I would like that kind of salary, like no limit. Okay, so is this person disqualified? Like, do they have a lot of power? Yeah, it's the president, so I would say yes. Are they getting an excess benefit? Why? There's no max. Who gets a salary like that? Isn't your salary like usually like? Yeah, that's true. Salespeople do get that,
And it's
but
based on him increasing
yeah, that's true.
revenue.
But a salesperson is not a disqualified person though, because they're not like influential. But the president,
But presidents of normal companies get that kind of package all the time. Like with bonuses if they like meet certain like
right, or they like stock options, like a certain number of shares. Yeah. So that's probably kind of the reason why like AU's president like makes millions of dollars. Is that an excess benefit? Sometimes it's hard to say, right? So if you had to like say yes or no to this, what would you do?
I think because of the.
Okay, I would agree. Depends. But if I was the accountant, I would like say don't do that. Like we're gonna say yes because most accountants are conservative, right? So you can say it depends. That's fine. Or yes. Number 3 is not controversial though. We have Anne. Anne is a member and director of a symphony organization. She receives 20 free admission tickets as a member of the organization. Is Anne a disqualified person? She's a director, so she has a lot of power, so she's a disqualified person, yes. Is she getting an excess benefit? No, because they're free tickets. If they're free, then what is she getting that's excess, right? I get free tickets too. Like if I go to the department upstairs, they have like, I don't know, like some like a sporting event that, you know, maybe they don't have a lot of people going to. They have like stacks of tickets that are free. I just take whatever I want.
So if they weren't free, it would be.
If they were not free, I would say yes. But if they're free, they're not worth anything, so there's no excess benefit. I would say no. The answer is no. All right, how about the local chapter of the United Way recently hired Joe Curtis as its new president at a salary of $200,000. All right. The outgoing president was paid $150,000. Mr. Curtis had other offers which ranged from $95,000 to $190,000. The minutes of the meeting reflected that he was exceptionally talented and would not have accepted the position for a lower salary. Okay, so with regard to Joe Curtis, is Joe Curtis getting an excess benefit? It's hard to say. Really tough to say, right? You could make an argument for yes. You could say maybe not, right? But is Joe Curtis a disqualified person? No, because they just got hired, right? They had nothing to do with their salary package, right? Like this person didn't even work there until you hired them. I mean, after they get hired, like that's a different story, but Joe Curtis was not somebody that was disqualified because they didn't even work there yet, right? So they're not somebody with significant influence because they just got hired. So that would be definitely no. All right. Good. Any questions on that? All right. How's everybody doing? Good? All right. We'll talk about one more thing. On page 4, if you evaluate a not-for-profit entity, we talked about one way to do that, right? How do you evaluate a not-for-profit entity? You can always look at the program expense ratio, or if you want to look at the book, there's an illustration in the book which shows other ratios. But if you look at page 4, number 2, there are 3 types of ratios you can look at. You can look at measures of service effort. That's an input ratio. So you can look at an input ratio. You can look at a measure of service accomplishment. That's an output or outcome ratio. Or measure that relates efforts to accomplishments. That's a combination of input and output. Let's think of some examples ourselves. What would be an input ratio? How would you measure a not-for-profit's performance by looking at an input item? It's actually on page 11. How about number of hours you spend working? That's input, right? Everybody agree with that? What's another input measure that you can use? Expenditures, how much time you spend helping people, right? That's input. Right? How many phone calls you answer, that's more of an output or outcome, right? How about how many people I help? Isn't that outcome, right? Let's say that I run Meals on Wheels. How many meals do I deliver? Isn't that outcome, right? How fast do I deliver the meals? That's an outcome measurement. Yeah, efficiency, outcome or accomplishment. Input is the work you do. The output is the result of your work. What would be an efficiency measurement? It's usually per something, right? How many hours did I spend helping one person? How many input hours did I spend doing that? Right? Okay, give me one more input measurement, at your job. What could they measure at your job, for your performance that would be input based?
Or donations collected.
How many donations collected could be? How about if you work as an accountant? Yes.
Hours of time spent on quiet.
Yeah, how many days you come into work, how many hours a day you work. Isn't that input, something that you're doing? How can I measure your output? How many tax returns you complete? How many jobs you worked on that are under budget? All right, that's an outcome. How about efficiency?
How many audits?
What's that?
How many audits you get?
How many audits you get through that are under budget? You see, it's combining input and output together.
Hours per tax return.
Yeah, how many hours you spent per tax return that we made a profit on? Right? That's efficiency. Good. All right. Do you have any questions for me?
Are we doing chapter 13, please?
I don't think we're going to have enough time, so I'm just going to give you the answers. How about I type the answers and I'll put detailed explanations for everything. So, yeah. And then everything that we went over, I'll retype all the answers for you and post them tonight, too. I think there's a couple of multiple choice we didn't get to, but I want to be respectful of your time and not let you out late. So I'm just going to go over what's going to be on the test.